Welcome back to The Explainer. Today, we're jumping right into an urgent structural crisis that's unfolding in South Africa's retirement industry, literally as we speak. We're looking at a really eye-opening research report by Kumo Solutions. And guys, it exposes a terrifying reality: how completely legal financial products can, perfectly and entirely legally, trap and impoverish retired savers.
To really grasp the scale of this thing, we've got to start with a massive number: 5.5 million rand. That represents the absolute mountain of pension capital a retired South African teacher built up over 40 years of faithful public service. But at retirement, acting on what she thought was solid advice, she permanently surrendered this entire lump sum to an insurer.
Now contrast that huge nest egg with this number, 700,000 rand. That was the outstanding balance on her home loan, a house she'd been diligently paying off for 18 years. To put it in perspective, this debt was only 12.7% of her total surrendered capital. But because of how her pension was structured, she couldn't access a single cent of that 5.5 million to clear the 700,000 rand debt. And because of that trap, she's actually facing eviction.
Now, you might be thinking, well, doesn't she get a monthly payout? And yes, she receives an annuity income of 15,000 rand a month. On its own, that might sound like a pretty decent, steady baseline for a retiree. Until, of course, we look at the other side of her ledger.
Here's the catastrophic reality. Her required monthly bond repayment is 25,000 rand. That creates an immediate, crushing 10,000 rand monthly shortfall. I mean, she is mathematically guaranteed to default. And the most shocking part of this whole shebang, the financial system legally allowed, and you could even argue incentivized, this exact scenario to happen.
When this retired teacher fought back to save her home, her lawyer, Advocate Moafrika Wa Maila, took the case to court in June 2026. The judge saw the absolute moral absurdity of a bank evicting a woman while simultaneously holding 5.5 million rand of her capital. But just listen to this quote. The court's hands were completely tied. The legal void in the current system forced a judge to rule against an obvious moral right. The law was applied correctly. And honestly, that is exactly the problem. So here's our roadmap for today. 1. The R5.5 million trap. 2. Life versus living annuities. 3. 5 points of systemic failure. 4. The missing judicial equity. 5. Ethical planning and red flags. And 6. Recourse and reform. Section 1. The R5.5 million trap.
All right, let's zoom in on the human cost of this case. This whole situation revolves around a first-generation retired teacher. She was advised to lock her entire 5.5 million rand lump sum into a life annuity. Now, what makes this genuinely staggering, like you almost can't make this up, is that the exact same banking institution that administered this annuity is the very same bank trying to repossess her home. They hold almost 8 times the value of her outstanding debt, yet they're using the rigid rules of the annuity contract to just proceed with the eviction. Section 2. Life versus living annuities. To understand how she got trapped, we really have to look at the mechanics of these products. When you buy a life or guaranteed annuity, you permanently surrender capital ownership to the insurer. Your flexibility is basically zero. Your ability to access that capital to settle debt, legally impossible. Why? Because the money isn't legally yours anymore. It belongs to the insurance pool. Now, a living annuity, on the other hand, keeps the capital in your name. You carry the market risk, sure, but your capital passes to your beneficiaries. The absolutely crucial takeaway here is that a pure life annuity is categorically the wrong product for a retiree with outstanding secured debt, simply because it entirely lacks capital flexibility. Section 3. 5 points of systemic failure. Let's look at how this builds into a perfect storm where systemic failures just reinforce one another. Number 1, the FISA Act suitability assessment was completely ignored. An advisor legally must look at a client's debt before recommending a product. Number 2, her massive liability was left entirely uncleared. 3, they converted 100% of her capital into an inflexible life product. 4, and this is a real game changer, life annuities have historically offered higher upfront commissions to advisors than living annuities. This commission structure actively incentivizes advisor behavior over the client's best interest. And 5, the law currently has no equity provision to fix things once the ink is actually dry. Section 4. The missing judicial equity.
Let's move to the legal core of the issue to see why the court couldn't just intervene and, do the right thing. It comes down to judicial equity. That's the legal power a court has to look at a contract, say, okay, this outcome is fundamentally unjust, and override the strict terms. But here's the catch. The South African Pension Funds Act literally doesn't have the words written into it to allow judges this power when it comes to life annuities. Because you've surrendered the capital, current legislation strictly limits the court's authority to redirect it to settle a debt. So the law correctly applied by the judge is the exact trap that needs fixing.
Section 5, Ethical Planning and Red Flags.
So how do we stop this? Let's shift to a highly practical guide. Financial advisors have a profound ethical duty to align product features with their client's debt status. This means using specific, non-negotiable benchmarks. First, start with a complete liability audit. If a client has secured debt on a primary residence, the default first action must be to settle that debt. Next, build an 18 to 24-month liquidity reserve. Only then should you look at a hybrid annuity architecture, which means using a life annuity just to cover essential baseline expenses, while keeping the rest in a living annuity for flexibility. Oh, and ensure mandatory inflation escalation is built in, so the payout keeps its buying power. Ultimately, advisors absolutely must operate on independent, fee-for-service advice. This hybrid approach just offers far, far better protection against debt risks.
Now, if you're a retiree navigating this, you need a checklist to spot warning signs before signing an irrevocable contract. Ask yourself, is my advisor acting independently, or are they pushing a same institution cross-sell where my bank is just locking up my capital in their own product? Also, if an advisor is trying to convert 100% of your capital into a life annuity while you still have a bond to pay off, hit the brakes. No way. Ask how they're being paid. If it's primarily via a massive upfront commission rather than an independent fee, that's a glaring structural red flag indicating a major conflict of interest.
Section 6. Recourse and Reform.
If you or someone you know is already trapped, what are the actionable solutions? Here is the step-by-step pathway. Step 1. Submit a formal internal written complaint to the institution. Ask for all the advice process documentation and wait 6 weeks. If it's unresolved, move to Step 2. Lodge a complaint with the FAIS Ombudsman within 6 months. It's critical here to document precise financial prejudice. For instance, gather your bond statements and compare them against your annuity payouts to show the Ombudsman exactly how much you're losing mathematically because of the bad advice. And Step 3, report systemic mis-selling to the Financial Sector Conduct Authority to trigger wider industry investigations.
And you absolutely want to take that FISA Ombudsman route because of this critical number right here, 3.5 million rand. As of July 2024, the FISA Ombudsman's powers were materially upgraded. They can now award up to 3.5 million rand in compensation for financial prejudice resulting from missold advice. This is literally the most powerful recourse avenue available right now for a documented failure to conduct a proper suitability assessment. But ultimately, the law itself has got to change. The Kumo Solutions report argues for specific legislative clauses that prioritize individual judicial equity over contract rigidity. We need policy changes like a mandatory liability clearance certificate before any annuity is even sold. We must completely prohibit 100% life conversions if a client has an outstanding bond. We need a 30-day cooling-off period. And most importantly, we need a judicial equity offset, basically empowering courts to mandate debt restructuring when the annuity capital held at the same institution massively exceeds the debt. These changes are exactly what would prevent future cases of forced impoverishment.
The broader, more systemic point here is this. The victims of this failure are largely first-generation formal sector pension savers. We're talking about teachers, nurses, and civil servants navigating a landscape designed by and for highly sophisticated investors. From their perspective, they face severe information asymmetry and structurally conflicted advice. This isn't just an individual failure, it's a systemic trap that preys on trust and complexity. Which leaves us with this final thought. If a 40-year teaching career can end in legal eviction due to a single, structurally conflicted signature, is your own retirement capital truly safe from the fine print? I really encourage you to verify your own annuity suitability checklists, demand fee-for-service advice, and push for better regulatory protection. Thanks for joining me on this explainer.